Hello and welcome to Compounding Curiosity. I'm your host Kalani Scarrett, and this podcast is all about compounding your curiosity alongside my own through thoughtful interviews with interesting guests. For transcripts and detailed show notes, check out the links in the description. Hopefully you're as keen as me to learn something new, so let's get stuck in. Okay, how are we? Another multi-person podcast today. So today I'm lucky enough to have Daye and Balkar Sivia. So together, they write and run Value Punks, which is a publication focused on global stock research. Value Punks' aim is to provide independent, institutional grade research on good and actionable ideas in a way that educates, informs, and more importantly, helps build conviction. So Balkar has spent over a decade investing globally in the US, Indian, and other emerging markets, and is a CFA charter holder with a degree in electrical engineering from the University of British Columbia. And Daye has focused on Asian equities in his career, having worked in Hong Kong, Seoul, and Tokyo. He is fluent in both Japanese and Mandarin, and is a CFA charter holder with a degree in mathematics from the University of Toronto. So in today's conversation, we cover the story and origin behind Value Punks, value investing and what it means, and we touch on a few of their interesting ideas they've written about. So I hope you'll enjoy my conversation with Daye and Balkar from Value Punks. Cheers for coming on today, guys. I really appreciate it. And yeah, another three-person podcast. But for maybe to start off with, and maybe starting with Balkar, could you guys just both introduce yourselves, give a bit of background of your life and careers maybe prior to Value Punks, which we'll get into soon?
So I have a degree in engineering from UBC. After graduation, I started working as an engineer and, for the first time making money. Again, as an engineer, you think you can kind of do things a bit better. So I started investing on the side. And, as I was learning, I kind of, read Buffett and read Munger and kind of really got hooked and figured that I was young enough to make investing a full-time career versus my job at that time, which was in software development. But then with a non-traditional background, it would have been difficult for me to kind of get into the business. So I kind of, again, followed Buffett and Munger and just started researching companies and writing reports. Then I would send these reports to managers that I respected and wanted to work with. One of the managers in Vancouver, Tim McIlvaine, took some interest. Tim himself had gotten a job with Peter Cundall by faxing him reports. So he started working with Peter, got promoted to the CIO of Cundall Funds, and then branched off and kind of started his own investment partnership. And I was a part of that for 2 years. So he kind of gave me my break in the industry. In 2012, I kind of got an opportunity to work with Burgundy. For kind of Burgundy is kind of a big name in Canada. It's, they manage about $30 billion across kind of different mandates, but mostly with a quality value philosophy. So, I worked with Tim, and Tim was more of a deep value guy, and then Burgundy was more quality value. So here I was in the emerging markets team, which kind of encompasses many countries, but I really learned how to kind of apply kind of many of Buffett's lessons in analyzing companies and kind of go deeper and deeper and kind of peel the different layers as you look at a company. In 2021, I founded White Falcon Capital, which is the current firm that I spend majority of my time at. So this is essentially an unconstrained, long biased mandate with a focus on producing absolute returns. So I'm essentially an emerging manager with a no management fee, a 0-0-15 fee structure. And I was talking to Daye, and Daye has a similar structure, even more generous. And we, given no management fee and being emerging managers, we figured we collaborate on something that where we can both kind of put our names out there and maybe earn some side income. So we co-founded Value Punks, which again we'll talk more about during this conversation.
Yeah, so many things to follow up on. But Daye, do you want to explain you first, and then I'll ask a few follow-ups?
Sure. So my whole career, I've been focused on public equities research. So I've been doing that since 2012, and so it's been 10 years. And the first 5 years I worked out of Toronto, and at the same company, Burgundy Asset Management, as Balkar just described. So that's where I met Balkar, and we were colleagues for 5 years there. And then the last 5 years, I've been based in Asia, in Hong Kong and Seoul. So most recently, I was with a firm called Mackenzie Investments. It's a Canadian asset manager, and I was based in their Hong Kong office. And I was part of a global large cap team with Asian markets as my primary research focus.
Yeah, so with what you guys do now, it's pretty unique. So was there anyone you looked towards for examples or even chatted with that had done something similar in the past, or are you guys starting from scratch and figuring it all out yourselves as you go?
I think from my perspective, I'll just say that, kind of having joined Twitter, there were a few other people that were doing this on Substack, but kind of being a bit of a student of, investment management businesses, that, there's always a large component of marketing, and a large component of kind of just putting yourself out there built into these businesses. I mean, Ben Graham used to be a professor. Buffett has taught. So it's, this was, we knew we had, given that we had just started our shops, knew we had to kind of put our name out there, and we figured this was kind of one of the ways to do it.
Yeah, cool. So whoever wants to explain this one, could you please explain the idea and the reasoning behind the punk itself?
Right. So I'm guessing most of your listeners would be familiar with CryptoPunks, right? So basically our logo is like a punk or NFT, if you want to call it that, of Warren Buffett. And frankly, we kind of just at first we thought it was just hilarious, right? Because you kind of have the polar opposite, right? Because you got the most insane kind of investment subculture with no regard for value on one hand, and then you got Warren Buffett, who's the most value conscious investor in the world. so we just found it hilarious. But actually there's a bit of a more serious note to this as well, because as Balkar said earlier, we started our career in Toronto at a very, very conservative investment shop, which manages endowment money and money for a lot of older high net worth clients. So while there, we really studied Buffett closely. So that was our starting point. But then also gradually over our careers, we really try to broaden the kind of stuff we look at as well. So for example, Buffett hates gold, as you know, right? And we've looked at that and we decided, hey, we like it and we want some portfolio exposure to that. And then Buffett's also not that keen on tech, but we've spent a lot of time there too and have invested a lot there. So if you go on our website, you'll see us cover stuff from very traditional businesses like banks, all the way to tech and things that Buffett himself wouldn't consider, investable probably, right? So it is kind of about starting point being Buffett, but we expand our own circle of competence, knowing that we're probably going to make some, I guess, mistakes along the way as well.
Yeah, perfect. Because cloning only gets you so far, so you got to add a little bit of what's your own. And maybe starting with Balkar here, stock research on Substack is obviously a hot topic, and there's a lot of people doing it. But how do you view Value Punks' strength and maybe unique value compared to others?
Yeah, so Daye and I had a lot of conversations on this when we were just starting out. I mean, first of all, we just kind of bring in a lot of experience to this, right? So kind of combined, Daye and I would have more than 25 years of experience. And this is again experience in kind of established blue collar investment firms. In this time we have made mistakes, we've had successes, and we've kind of learned from all of that. We have learned from people that were much more experienced than us, that worked at these firms, and kind of derived lessons from them. So now we are just kind of putting all of that together into our reports as we kind of research and write and publish. And then one of the things that we found that was a bit missing in kind of the Substack discourse, I mean, it was very focused tech, it was very focused some of these popular companies. It was there was almost nobody doing international stocks. And there was kind of not many people doing, writing on companies opportunistically, where, you can kind of, ideas are actionable, day one, because the valuations are where they are. But again, in our day jobs, Daye and I are both looking at stocks all the time for our own portfolios. And then a subset of those, which we think would be relevant to a broader audience, kind of make it to the Value Punk Substack.
Yeah. And Daye, anything to add there?
Yeah, just briefly, I guess the starting point was kind of let's take whatever we kind of did at our, research jobs on the buy side, the kind of research we produce internally for our portfolio managers, right? And let's just do similar kind of write-ups as that and try to make it public and see if people like it. Because I think, a lot of folks in the industry who are, I guess, folks who are not in the industry, right? They might be curious, what kind of research is done on the buy side? And so we kind of put it out there, right? This is the kind of write-ups that we produce for our, portfolio managers while working for these long-only, these billion-dollar funds. So, not saying what we do is relevant for everyone, but I think it could be useful for, I guess, first, buy-side portfolio managers, but also students or people aspiring maybe for a research role in the future, right? And you can kind of see what is maybe to be expected, in these kind of research roles.
Yeah. And to go back to you, Daye, and then Balkar can chime in after. You guys are both analysts at big institutional funds. So how is doing research different from there, doing it as an independent writer now compared to doing it as a large asset manager?
Yeah, so definitely pros and cons, right? You obviously get a lot more corporate access and other resources as a large manager, and that's something we miss for sure. I'm not really sure how much of your listeners actually come from the buy side or have been in that seat, but the one important thing, I guess, to emphasize is that when as a buy side analyst, you aren't really writing the report for a general audience or for the world to read. Usually you're just reporting to a single portfolio manager, and most of the time it's this one person who is evaluating you and deciding on your bonus and whatnot. So you can imagine in this kind of setup, right? There'll be some interesting, let's just call it institutional nuances. So to give you an example, right? Many analysts, they see one of their most important jobs as to get their portfolio managers to buy their ideas. And because that's the way, they would measure the impact you have as an analyst and what your year-end bonus is going to be and blah, blah, blah. So you can see, with this, there's a bias to be positive, because when you convey such a nuanced position to your portfolio manager, right? They don't know if you have the conviction. They want to test to see that you've really done the work, you have conviction, let's buy this idea kind of thing. So, that's an example of what drives behavior in that setup, right? And then I've also seen in some larger shops, the teams can get really, really big for some large cap mandates. I've seen teams as big as 14 people. That wasn't really my team, but you can imagine in that kind of situation, everyone's competing for the portfolio manager's time. You want to get on his good side, right, with that one rare interaction. So the focus isn't really about the research anymore. It's almost like a beauty contest. So I'll just say, as an independent analyst, I think Balkar and I think we were enjoying this in the sense that you don't have to think about any of that stuff. You just focus on the research without worrying about the institutional and the political side of things, and it's almost as good as it gets.
Yeah, interesting. And Balkar, anything to add there? How have you found it?
Yeah, no, I'll just second what they said, in the sense that it is much more enjoyable to write on Substack for a more broader audience, and just have the freedom to kind of because it's your own Substack, to say what you want and say what you don't want, work on the ideas that you want, don't work on the ideas that you don't want just because you know that those ideas would, again, as Daye is saying, create a bigger impact on the portfolio. But again, just the other part of your question is, I think there's nothing, given all the free research tools that are today available, that are out there, I don't think there's anything that impedes somebody outside a big institutional buy-side firm to do similar quality research as you would do inside that firm. You do have to hustle a little bit more, but I don't think you're at a disadvantage at all.
Interesting. And yeah, something I'm interested about with you guys and your work, and maybe Balkar, you can start off with this. How does division of labour work when writing together? How do you guys plan and go through the process? Just talk me through that.
Well, Daye's the taskmaster, so I let him take it.
So, our universe is global, right? Like coverage universe. So, I guess in that sense, it does help to have two people to cover such a wide universe of international stocks. But I think the more important part is that it also keeps the two of us honest. In a sense that we actually review all of each other's work. Everything that we put out, both of us goes through it. And so Balkar would say to me, for example, hey, there's an important piece of analysis here that I think you might be missing or something. And we would try to ask each other the tough questions before our readers would ask us. So I think that helps to keep things rigorous somewhat. It definitely has its challenges though, right? Doing this with two people. I would say consistency is something we worry about sometimes. Consistency of writing when you're juggling between two people. I would say this, right? We only gave it a shot because we worked with each other. We know each other well, so having been former colleagues for 5 years. This kind of setup, I don't think it's something that I would recommend to everyone, because the truth is co-founders and partnerships, they fail more often than not. So it's really important that to think about it, and trust is really, really important.
I'll just add here that this idea came to me, but I was not prepared to do 12 reports a year, which is what any relevant reader would want to see from a Substack. But what happens here is Daye and I split the work. We do 6 reports each, 1 report every 2 months, and that becomes very, very doable. Again, we have our day jobs, right? We have our individual kind of investment management practices where we spend a majority of the time, and then from there, whatever is relevant, we can kind of apply that to Value Punks. And with two people, not only do you share the work that kind of comes with writing, but you also share the admin, the strategy, the other aspects of kind of running and operating a Substack. The last point that I'd say here is that every investor is different. Daye and I think alike in many ways, but we're also very different. I mean, the ideas that Daye brings to the Substack, I think are very unique. His perspective is very unique, that I wouldn't be able to bring. And I think similarly, some of the things that I can bring to the table, Daye hasn't worked in those markets to kind of talk about those ideas. So again, I think working together, kind of having the Substack together, I think it kind of gives the reader kind of a more diversified, thought out product.
Yeah, fair point. And to move into the content and idea side of your work, Value Punks obviously focuses on international ideas, which has been a challenging time, is one way to put it. So it's the 25th of October now, just for reference. But given how the world is changing and how tough this year has been especially, does this change your thinking regarding your focus on international companies, or how do you view this whole shift?
Yeah, maybe I'll take that. It's we started off with international, kind of knowing that international has underperformed for more than a decade at this point. Having said that, international has always had kind of bursts of outperformance compared to U.S. equities. The 2002 to 2008 time period was kind of the last time period where international equities, emerging market equities, did really well compared to the U.S. And you'd have a time like that again at some point in the future. We don't know when, but what we have is we have a Substack with kind of a large repository of inventory of these ideas, quality ideas, that I think when and if the market kind of moves towards our style international companies, I think then we can kind of be very, very relevant to many players. In the meantime, we've argued in one of the posts we wrote, why investors should consider investing a part of their assets in international markets. And one of the biggest reasons, and we are value investors at the end of the day, and one of the biggest reasons is valuations. Pound for pound, quality for quality, international companies are cheaper than U.S. companies. They grow their earnings. They have aligned shareholders. Management compensation is not that not as bad as some of the U.S. companies. And then for people that have international benchmarks, it's been a bit easier to outperform with international companies than it has been, if your bogey is the S&P 500. Again, if from our perspective, if we can make the case for somebody having a portion of their assets in quality international companies, I think that's kind of what we're aiming for. We're aiming to kind of occupy and dominate that niche.
Yep, very good. And Daye, anything to add there?
Well, maybe just a small subtle point is that if you think about it, like public equities is like the most efficient, low cost way to get international exposure, right? Mm. So if not public equities, like how else do you plan on getting international exposure? Unless like you don't want to do that at all. Like private companies, no, right? Real estate, no. Like this is your best and really, I think, the only way that anybody could add some geographic diversity to the portfolio. So I think it's worth thinking about, and just taking advantage of this really like simple fact.
Yeah, totally agree with that. And in value investing, more so in general, you guys wrote a piece back in April titled "Value Investing Revisited." So you challenged some conventional thinking around the value investing community. Balkar, do you want to start with that, and then Daye can follow up?
Actually, maybe I'll talk about it because I mostly wrote this article. Yeah, so like it basically really comes down to the fact that we don't think there are any hard truths out there in investing. And maybe that's lost on some people because, in our opinion, value investing seems to have especially gotten increasingly become like a dogmatic field. Just look at how many accounts there are on Twitter that do nothing other than, quote Deng, Charlie Munger, Buffett and all that, right? So, like, people think you just follow these timeless principles and you can do okay. Now, what's interesting though is that when you look at the reality, right, and what you tend to see is that so many investors lose money and get hurt by being so dogmatic with these principles, and that's actually what we observe. So, the way I think about it is like, the application is very nuanced, right? Buffett makes this sound so easy, but it's literally like listening to a pro parkour athlete telling you, okay, jumping across that 10-foot cliff is so easy. Like, you don't take that at face value. You have to think situationally. You know what I mean? For this piece, what we did was like we tried to give like a practical footnote to some of the most referenced value investing concepts. And it's important to know how each one could not only benefit you, but also hurt you at the same time. Like just as an example, right? We talk about, there's this like, everyone likes to say volatility is not a risk and that it's a friend that you take advantage of, right? That's what Ben Graham and Buffett teaches us. But in reality, what do we observe? Well, most people get burned by volatility. That's what I see. And, and that's because people are not taught to think of volatility as a risk. That's part of the reason. And because of that, for example, they don't demand to be adequately compensated for taking on that volatility, which is a problem, right? There's this other concept, like, Mr. Market is this like really irrational, manic depressive character. And I also think if you take this to heart and don't question this narrative, it also has more potential to do harm than good. Because, like, how many people do you know who thinks that the market is dumb, but they're the ones who lost substantial amount of money, right? So they would have been better off if they thought that the market is like smart, and that they might have that might have prevented them from doing stupid things. So like, we've just identified like a couple of these points and wrote about them, and like I guess I would encourage listeners to check it out if it sounds interesting. We have some funny memes in there too. Yeah. Go check it out.
Yeah, the Mr. Market description I very much agree with, because it can be a bit of a coping mechanism. If you have losses, oh no, it's not me, it's Mr. Market. So I'll maybe go with Balkar now. So obviously you're an emerging market analyst for 10 years, but you've written on some emerging market banks, including HDFC and NU. Do you want to talk about what's interesting there, and just tell us what's your thoughts?
Again, being an emerging markets analyst, I had the opportunity to kind of look at banks, because the banks in emerging markets and the opportunity in banks in emerging markets is very different from that in the US or Europe or Japan. Anybody who started investing after 2008 probably doesn't know how to fundamentally analyze a bank, because why would you ever look at a bank? Because they are bad businesses and they kind of blew up during GFC. Again, but in emerging markets, they have been some of the biggest compounders. Again, if you think of a typical emerging market, again, ex-China, these markets are, typically speaking, capital starved. GDP is growing at a high rate. There's also inflation, so nominal growth is high, requiring high credit growth. And on top of that, you have, the better banks taking share from some of the weaker banks, and then also a large swath of kind of unregulated entities like moneylenders, which exist and have large shares in these markets. So we kind of used HDFC Bank, which is kind of the largest private bank in India, as kind of an example and kind of a primer on how to analyze a bank. So again, if you look at the balance sheet, you look at the income statement for a bank, it's all kind of very different compared to a regular operating business. And there's some nuances there that are important to appreciate, and somebody who hasn't looked at a bank in the past wouldn't know. So we try to kind of peel that onion and really kind of bring forward a framework to analyze a financial institution. HDFC Bank itself, again, has been a big success story coming out of India. The bank has compounded in the low 20s over 25 years. Coming into this year, it had some short-term headwinds due to which the stock was available at a discount to its historical valuations. So we figured it was an optimal time to kind of do a write-up on the bank. So that, it was received quite well, which we were happy about. But then again, given the diversity of thought that we have here at Value Punks, Nubank, which is a bank in Brazil, is a very different story. So HDFC Bank is kind of your steady Eddie compounder that kind of does the same thing year over year, grows book value at high teens every year, while keeping credit quality very, very high. Nu is a neobank, which is following the business model of a Capital One or a Tinkoff. The business model here is essentially to introduce credit cards to the population with a digital first strategy and a great customer experience, and kind of use this kind of credit card as a customer acquisition tool and then a data gathering tool to then sell other products to this customer to actually make money. again, you manage the risk on the credit card portfolio, which is an unsecured portfolio, by both with data and by keeping just low limits to the customers in the beginning. So again, it's a little less proven compared to an HDFC Bank, but we know that it's not easy to build a bank in a country like Brazil. It's even more difficult to execute on the strategy, and they've done a great job. In between Brazil, Mexico, and Colombia, they have 70 million clients.
Wow.
The thesis is that these clients are currently doing about $7.8 per month, and they can eventually go to $10, $12, $15 a month, which kind of more than doubles their revenues. And with the operating leverage in the business, you can have a business that's trading at kind of single-digit PE in 2025. So again, kind of a very different approach to valuations, a very different financial, very different country, but kind of applying the same value investing principles, looking for good operators, quality companies. We think they're both very, very investable, and kind of both good ideas that can do kind of high IRRs from here.
Yeah. Great explanation. I love it. That's such a good rundown. So Daye, now your turn, I guess. So you wrote about Hong Kong Exchange. So you've lived and worked there as well. What's misunderstood about that opportunity, do you think?
Yeah, well, interesting timing, right? We just had China's Congress like a few days ago, and the market's been kind of crazy. Maybe I won't go into that here. Yeah, there's just been so much, I think, bearish pieces written about Hong Kong in the media, and recently I was reading about an article saying, how Hong Kong is losing to Singapore, right? People cite these financial center rankings and go like, oh, Hong Kong's going down the rankings. But I think like one of the best ways to really understand just like a financial center is to look at the most important infrastructure, which is exchanges. And I really think more people should be doing this because like they really disclose some good information. And once you start seeing this, you start to understand, okay, what are Hong Kong's strengths as a financial center? And for example, why can't Singapore just like replace Hong Kong? And I'll just tell you something interesting because there's a bunch of people right now who think Hong Kong is losing its relevance or market share, right? But if you look at the data, in fact, like Hong Kong's relevance has actually only grown, and that's counterintuitive, right? So, for example, with Singapore, right? Let's look at like A-shares futures. So Singapore used to be a monopoly in the world for trading offshore, A-share futures. And then last October, Hong Kong came in and really came in from nowhere and grabbed 15% of the shares in less than a year, right? And if you go read some interviews, it's actually the Singapore execs that are worried about this and not Hong Kong. And it's not just Singapore that Hong Kong kind of taking share from, but it's also the U.S. as well. In that, you got these geopolitical headwinds, as everyone knows, with the delisting risks, right? And those have been leading to homecomings of mainland tech listings. So we've actually seen volume migration from names like Alibaba, JD, NetEase, all these Chinese internet companies. Volume has been migrating from the U.S. to Hong Kong through this process of ADS conversion. So like investors in the U.S., they could convert their U.S. ADS to Hong Kong listed shares, right? There's a process for this, and these shares are fully fungible. So when you look at the data, Hong Kong is actually taking volume share from the U.S. in a couple of years. You look at these trading for these names, like Hong Kong volume could actually eclipse the U.S. And I just think not many are talking about these underlying trends because like the market's been doing horribly this year. Everyone is suffering. But maybe this is like masking the underlying trend where Hong Kong has actually been taking share in some of these places. And so yeah, so in this piece, like we talk about these long-term structural opportunities for Hong Kong that I think it's getting increasingly hard to find because everyone's just so bearish about the prospects there.
Yeah, it's just the geopolitical risk gets everyone in a tiz and they can't even, all logic goes out the window.
But I think on that point, I just think like there's geopolitical risks, but there has been that risk all the way until now. And if you look at Hong Kong Exchange, they've doubled their profit in the last 5 years, right? Even amidst geopolitical risk. So I think the more important question is probably to think about, how is Hong Kong really aligned with China's development? And I happen to think that they're quite well aligned. And so that is really the driver for a lot of the growth there. Yeah.
So one last general question before I get into my closing round, as I'm very conscious of both you guys' time, especially Balkar, so late at night. But evident from your work, and you've mentioned it very briefly beforehand, but a ton of work goes into the ideas. But what happens if the price moves substantially or a curveball hits the company when research is nearly finished? Like, how do you navigate these kind of scenarios when you're doing a write-up?
Well, maybe like I'll go first, and I don't know if I have a great answer, but maybe Balkar can add. But I think I think this is one benefit to doing in-depth deep dives, in the sense that it gives you some context to assess things. So hopefully by the time the curveball comes, you would have spent enough time deep on the history, the management, business model, enough to really make an informed decision on that curveball. And you have to determine if that curveball is completely thesis altering or not, right? And it also helps that it helps to try to kind of treat your write-ups not as a sales pitch, but more like providing both sides of the story, so that and we try to do that as much as we can. So getting out of this sales pitch mentality helps, because you're no longer that stressed when shit happens, and because it's less about making that pitch and driving that narrative, but it's more about providing a balanced view, right? So we try to provide actionable ideas and we try to be bullish, but it doesn't have to be always. Yeah, Balkar, you have anything to add?
Yeah, no, I'll just quickly say that the way we look at it from an investing perspective, kind of a lot of the job is just to kind of get to know companies, get to know them well, and then follow them for a while, and just wait for the price to kind of come to you, right? So part of what we are doing here is also educating, right? We are trying to do a deep dive, trying to really go into kind of unit economics, trying to really go into what the business does, its history, its kind of management, culture, all of that, so that the reader can appreciate what the quality of the business is, and then I've found, even through personal experience, that valuation is something that kind of everybody looks at differently based on their own biases, right? I mean, something that's cheap for me is not cheap for you. Something that's high conviction for me is not high conviction for you. Again, because the way you and I kind of think about risks is different. The way you and I think about returns is different. So it would be difficult for us to kind of, always have an actionable idea for every person that reads our post. So it's more about, can we, did you learn about a new business model? Did you learn about a new industry? Did you learn about a new management team that's doing things a bit differently? And can you then kind of apply those lessons to something else that you're looking at, right? I mean, most of what we do, Daye and I at this point in our careers is, we've built this database in our heads of kind of, business models, mental models, things that work, trends that we know work. And then we try to just look for similar things that have, that can have relevance for our portfolios and for value punks. So that's kind of the objective here, to both to kind of provide ideas, but also to kind of educate and inform.
And I'll go on to my closing round of questions. So I'll start with Daye first. What do you think is an underrated skill or an experience that university age students don't give weight to? So what do you think is an underrated skill or an experience that you think they should have, or maybe something that you wish you had at the time and developed earlier?
Yeah. If I could go back in time and tell my 18-year-old self, I think I would try to tell myself to be more curious about history and to know more about history, right? Because when I was younger, I used to think history as this useless humanities degree, right? And I was a science student. But now I've come to a point where I think, like, I really think if you don't understand history, then you don't understand the present. And, there's even less chance you can forecast the future. So I definitely wish I came to this realization earlier. I think that's one underrated thing I would tell younger people.
Balkar, for you?
Yeah, I mean, there's there's a lot of things. I mean, there are different things from a life perspective, different things from a, if you want to work in this industry perspective. Maybe I'll talk about the latter. And it's just that, in the beginning, I think, young people just have to say, I don't know anything, and then just go on finding answers to everything that they, think they don't know. And if they think they know something, then keep asking why, right? Keep asking why. And, you'll realize very quickly that there's a lot that you don't know. Why does this has to have a 15% operating margin? Why do earnings have to grow at a certain level? Why does the management take that decision? Many things that we take as obvious are sometimes not obvious. Sometimes the answers that are in front of us, the easy answers, are not the right answers. So I think it's just very important to be curious, very important to learn, very important to put in the effort, keep your head down. When Warren Buffett was asked, how do you start? And, he just goes, I pick up the Moody's manual and start at A. I think that is the right advice. There's no shortcuts in this business. You just have to go report after report, annual report after annual report, company after company, put in the time to be able to kind of accumulate knowledge that can then compound for you as you kind of grow in your career.
Yeah, and back at you again, Balkar, and then we'll go to Daye. And you can treat this as either life or investing, but any books that have been influential in shaping you and your views.
I think, many books. I think, again, in the beginning, for me, it was all kind of about, Buffett and Munger, and just kind of reading everything that they kind of put out there, their letters, their partnership letters, books, etc. And that, I think, would have had the biggest influence on just not how I invest and kind of think about business, but also in terms of how I kind of live my life. I think some of these, again, from a younger person's perspective, I think a lot of people, read, one book and say, I know what Buffett said. I think you really have to kind of go through a lot of material to kind of really kind of get to understand, what he did, and what they're trying to say and how they kind of live their life, and, how they were able to kind of build Berkshire into what it is today. So that would be, I think, the biggest influence from my perspective.
Yeah. And you, Daye?
So if I was to give, two book recommendations, I'm really a big fan of Joe Studwell's books on Asia. Yeah. So How Asia Works and Asian Godfathers. Kalani, have you read them?
Only Asian Godfathers. How Asia Works is very next.
Oh, it's a must read, I think. I think for those who are looking to invest in Asia, or just to want to understand Asia in general, it tells you how things got to where it is today. And just kind of going back to my previous point about history being something I think is super important.
Thank you guys so much for coming on today. Anything else you want to add, or where can people find you, obviously, and anything you want to plug? Check
us out at our Substack. Both Balkar and I are also on Twitter as well.
Perfect. Balkar, anything else?
Yeah, no, I'll just say, kind of check us out on Value Punks. It's, let us know if you have any questions or feedback. We kind of love to hear from our readers. And you can find us on Twitter. You can find us on LinkedIn. If anybody wants to get in touch for anything, I'm happy to talk.
Perfect. Thank you guys so much for coming on. Been a blast.
Yeah, likewise.
Thank you, Kalani.
If you enjoyed this podcast episode, be sure to check out the website compoundingpodcast.com. On the website, you'll find every episode complete with transcripts, show notes, and other related resources. If you want an email notification every time an episode releases, plus my lessons and takeaways from each episode, be sure to sign up to the Substack. So that's compoundingcuriosity.substack.com. Either way, links to all content mentioned today will be in the description below, and you can also connect with me on Twitter @ScarrettKalani. But until next time, have a good one.